Good day, I'm Professor Dusan Ecim, and today I'm going to be taking a look at what it means to be reporting differently. So myself and my colleagues at the School of Accountancy have been doing quite a lot of research into aspects of corporate governance, assurance, and reporting, and these are all very topical things that are taking place today in the organizations we're seeing in South Africa. So to start off, I want to take a look at what it exactly means to have these kind of different reports. We're all very used to seeing annual financial statements where we've got the income statement and balance sheet. But organizations are starting to move to report on broader aspects. They're starting to report on aspects in addition to financial capital, such as natural capital, social and relationship capital, human capital, intellectual and manufactured capital. So this entire output ends up in these things that we call extra financial reports. So we get a whole suite of reporting, such as integrated reports and sustainability reports. And the objective is for the company to try to communicate to different stakeholders exactly how they're impacting all of these different resources. Now, on the backdrop of this, you can't simply produce an integrated report while only having a financial mindset. It's underpinned by something that we call an integrated thinking logic. Now, integrated thinking has become synonymous with balancing financial and extra financial matters as part of a more comprehensive approach to your risk management, strategies, operations, and performance evaluation. Ultimately, integrated thinking is this holistic approach to managing your business, and it's being championed and heralded as the solution to our growing environmental and social problems. In addition to this, there's a lot of stakeholder and institutional pressure for organizations to be adopting this integrated approach. Finally, on the backdrop of all of this, there's a lot of sustainability-related guidance that's coming out to help organizations to produce all of this. So we've got the ISSB's, IFRS S1, S2, the GRI, the European Union is coming out of the CSRD. It's basically this entire alphabet soup of different sustainability-related frameworks that are trying to promote this more holistic output in your reports. So we get to this question now and this adage to go and say, what came first, the chicken or the egg? Should the extra financial and the integrated reporting come first, or should integrated thinking come first? Now, on the one hand, you can argue that you need to first have the proper controls and management information systems in place to be able to collect, gather, and analyze all of this extra financial information. You could also argue that you need to have that corporate culture and that will to want to create this long-term sustainable development and value creation. On the other hand, you could argue that maybe first organizations need to be forced to report on all of this ESG-related matters. So almost like a tick box prescriptive approach where they have to go and do it. They don't really want to, but they're ticking the box. And then hopefully through this process, they take a pause and say, well, listen, actually, I can see the benefit of this. I can see the benefit of conserving the biodiversity in my area. I can see it's actually creating longer value creation for myself. And now I'm becoming more of an integrative thinker. So in all likelihood, what's happening is that reporting and thinking are developing in tandem. And slowly, as you're reporting more, as you're starting to understand what you're reporting on, you become more integrated and you bring this into your business model. This now brings us to the question of how do we have assurance that these extra financial reports, these sustainability reports, are valid, accurate, and complete? Now, financial audits have been taking place for a long time, and it's very easy to go and confirm that the revenue balance is correct, confirm that the bank balance is correct. But it's much more difficult to actually go and say, well, are these carbon emissions really being reduced by what the company is saying? Is this company's water usage, is the way that they're treating their employees, is all of this really what they're disclosing? A lot of this is intangible in nature, and it's quite difficult for assurance providers to get comfort over it. In addition to this, there's these underlying tones of impression management and greenwashing that could be coming through in these extra financial reports. So we need to be cognizant that because the information is much harder to assure, it becomes a lot more difficult for stakeholders to get comfort that what organizations are reporting is really taking place. So two problems that come in over here is, first of all, what happens when the business model is not compatible with this ESG focus and with this integrated thinking focus? And second of all, what happens when there is this underlying impression management that's taking place? So with regards to the former, in terms of the business model not being compatible, it becomes very difficult with how can these organizations truly become an integrated thinker? Because if we look at, for example, organizations in the petrochemical, oils and fuel, ultimately their business model is using fossil fuels, using crude oil. And we understand that that is to some extent going to be damaging our environment. They can't necessarily now go and change their entire business model. And you can't now go and use wind energy, solar energy to fuel up a car that's based on fuel. So it becomes very difficult for these organizations to genuinely be able to change that core business model. And the question becomes, well, can they change other aspects of their business to perhaps be integrated in other aspects and make a difference, donate money towards other environmental causes that will rehabilitate the environment? So there is still solutions, but for those organizations where their business model doesn't lend itself to being fully integrated on the environmental front, it does become a little bit difficult for them. This problem gets compounded with the latter issue I mentioned, being the impression management and greenwashing. So what my colleagues and I have done is we use this technique called the bibliometric analysis, where we download all of the academic literature relating to a specific topic. And in this case, we downloaded approximately 1,211 articles that related to impression management and greenwashing. What we then do is we run it through the software called VozViewer, which thematically visualizes all of the core themes related to this. And from this, we've developed about 15 tactics of impression management and greenwashing. Now, to take a step back, impression management is effectively you trying to portray yourself in a better manner, or you slightly changing the way you disclose things to influence people or to hide things that aren't really necessarily best practice that you're doing. Similarly, greenwashing is effectively, on the financial statement side, we get fraud. When you misstate your revenue, for example, on this side, we get greenwashing when you're trying to misstate your carbon emissions, your environmental performance, things like that. Now, these 15 tactics that we've gone about to develop aren't necessarily foolproof. It doesn't mean that when you see this taking place in a set of extra financial reports that there is definitely greenwashing, but it's more of like a red flag. It's something that we refer to in auditing as you have to have increased professional skepticism. So as part of that, you approach these extra financial reports and these sustainability reports with that questioning mind. You say, okay, I'm seeing here's a potential tactic of impression management. Let me dig a bit deeper. Let me do a little bit more work, get a bit more information before I make a definitive conclusion, because there could be something funny happening. Now, as I've mentioned, assurance is one of the best ways that we can mitigate impression management. But again, the assurance of these reports is not as common, and often it's not mandatory, but rather voluntary assurance. So when organizations go and take voluntary assurance, we can get a bit of comfort that what we're seeing is valid, accurate, and complete, because organizations wouldn't necessarily have an incentive to spend large amounts of money on this assurance unless they genuinely wanted to present to their stakeholders that this was valid, accurate, and complete. So this shows an element of proactivity. So I'm going to touch on now some of these indicators or these tactics of impression management, so that when you're an everyday stakeholder picking up a sustainability report, you can have it at the back of your mind and just think about a bit deeper about whether or not these different ESG related disclosures are really what they're saying they are. So the first thing that we've picked up is that there's an element of perception management that takes place in these organizations. They'll have various press releases, media releases, website releases. They'll structure the websites in certain manners. They'll structure certain advertisements in certain ways to portray themselves as being these green initiative drivers, when in actual reality that might not be the case, because as I mentioned earlier, some business models don't necessarily lend themselves to being able to do that. So that's the first thing that we see, is that there's an element of perception management that takes place, and there's also an element of self-promotion that takes place, where organizations will often focus predominantly on their strengths, and they'll try to highlight these strengths through their integrated and sustainability reports. Every third, fourth page, you're going to see them highlighting these good things that they've done, but when it comes to the bad things, suddenly that's relegated to a little paragraph on the side of a report. So we can see through that organizations will often go through a self-promotion process to try to make themselves seem better than what they are in the ESG space. They also go through a thing of reputation enhancement and trying to build stakeholder rapport. So it's what we call image-driven philanthropy. So they're going to showcase charity events, showcase themselves donating to certain organizations, which of course is a good thing, but also can detract from some of the more negative impacts that they're having on our environment. Then we get intimidation. So often when an organization has a bit of a monopoly in the sector that they're operating, they can use intimidation to actually pull away from even doing these ESG related matters, because if they fall apart, they'll simply say, well, the service is no longer available to the market. So through intimidation tactics, through being a monopoly, we have to have that questioning mind to say, well, maybe this organization is actually not doing what they should because they have the power to avoid responsibility. Then something that's quite a nice thing to take a look at is how much is an organization disclosing qualitatively versus quantitatively. Organizations that are trying to hide certain things will often be very qualitative in nature. So they're going to have long paragraphs, very wordy paragraphs that say, we've reduced our carbon emissions, we are dedicated to the sustainable development goals, but they don't really give actionable items of how they've done that. They don't really give the quantitative numbers to go and back up that this is exactly how we've gone about things. They also don't give you an opportunity to do a bit of a post-implementation review. So comparing the figures across a 5-year time period, see have they really improved and how big are these improvements. So it's important to give quantitative numbers to all of these ESG related disclosures so that we're able to actually verify it and understand it. And obviously that will help the assurance providers to more definitively actually get the evidence to support those disclosures. The next thing that often takes place that you need to keep in mind is graphical representations. So you can distort graphs to look like and to portray this better image of yourself. So if you don't start the graph from 0, for example, and you start the graph and the axis or the y-axis at 500 units, for example, that's going to distort what this graph actually looks like. It's going to look like there's maybe a much bigger gap in from performance from one year to another, or if it's something negative you want to disclose, they might distort it in such a way to show that, when you look at it graphically, it doesn't really look like things have moved much. It looks like it's dropped a bit, but company's still doing decently. And then with that, they're not necessarily again giving actionable items. What were the risks that they faced? How did they mitigate this? How did it link into the business model? Often organizations in their sustainability reports also like using photographs. It looks a bit arbitrary and abstract, but these photographs can often influence people. You put photographs of the environment or of charity events and things like that, and that can change the perception of people where they think this company is doing really well and they're being influenced by these photographs, but that's not really what the underlying integrated thinking logic was in this organization. Then there's also an issue around selective disclosures. Because these sustainability reports are voluntary in nature, largely, it means that at the end of the day, the organization is not doing anything wrong by omitting certain disclosures. So they're within their rights to go and put all the great things that they did and put to the side anything bad that they did not even disclose in the first place. Again, if the onus kind of falls on the stakeholders here to do a bit more research, to dig into websites, to try to see any news articles that are popping up so that they can be informed of any issues that have popped up with this company. With selective disclosures as well, that becomes a problem for your audit assurance providers because at the end of the day, that assurance over this extra financial information is often voluntary in nature. And management can go and say, well, we only want you to assure this subject matter, the water usage. Please don't worry about our carbon emissions and that. We're going to put that to next year. Then the auditor that is part of their assurance engagement. They only assure the water usage. They say that there's reasonable assurance or limited assurance that this is all good. And at the end of the day, the electricity, the carbon emissions didn't factor into it. The onus then goes on the assurance provider to see, well, potentially do these other aspects that the company didn't want to assure, does that have an impact on the water usage? And do they maybe need to bring it within the ambit of their insurance engagement to take a look at? But again, we can see here, if it doesn't fall within that ambit, we as ordinary stakeholders who are looking at these reports won't necessarily get the insights into it. Then we get different obfuscation techniques, such as a lot of repetition, like I mentioned earlier, repeating all the good things and not necessarily going into detail on some of the more adverse or negative impacts of the company. Organizations will often use complex language, positive tones, overly positive tones, going into aspects such as using metaphors, focusing on the highlights of the organization and relegating, like I mentioned, the negative aspects to further along in the report or somewhere buried deep within the report. So these are all techniques that they might be using to hide certain aspects or just to impress on us that they're actually a good corporate citizen, when in fact that might not necessarily be the case. What's quite important over here is what happens when there's a change in the disclosures. What happens when they're changing the metrics that they're basing on, particularly for their performance evaluation. Now, performance evaluation is something that I can go into a lot of detail on, but put simply, performance evaluation needs to move from being financially focused. And we want to try and develop something called an integrated performance indicator, where management is actually being rewarded for, yes, of course, financial aspects of the business, but also how do they perform across the environmental aspects? How do they perform across their employee surveys? How do they perform across customer surveys? How do they innovate the business? Do they add to the intellectual capital? So trying to create this, what they referred to in the 50s and 60s as a balanced scorecard, and trying to now move it into the current climates that we're facing and incorporating all of these different touch points into management incentives. Because at the end of the day, if management can get incentivized to do a bit better, to be a bit more of a corporate citizen, then their own personal goals will be a bit more aligned with the organizational goals. So that's a way in which, if we take a look at these performance evaluation metrics and how they're structured, if we see that they're heavily financially focused, we have to take a step back and say, well, clearly they don't have an incentive to be a good corporate citizen. So are they really being a good corporate citizen? Then there's naturally certain things such as social media strategies, how this organization tries to portray itself in the public eye. In addition to this, we have to consider, do they deflect criticism when it comes their way? So when some valid criticism comes along, are the news articles reporting that the executives are simply deflecting and saying it's not their fault, or they didn't have the ability or oversight over that? Or are they actually coming in and embracing it and saying, yes, look, we have made a mistake, this is how we're going to rectify it going forward? That shows a bit more of an element of being this integrated thinker and a good corporate citizen. We also have to be aware of, I mentioned at the very beginning of this presentation, that potentially one of the ways that we can become integrated thinkers is through going through a tick box approach. But obviously that means that you're following the rules and you're not really interested in being an integrated thinker. So yes, even though that is one of the steps to eventually becoming an integrated thinker, if we see that these organizations are only ticking the box, are only doing things for compliance-based purposes, we do still need to take a step back and say, look, they may be on a journey to integrated thinking, but at present, there may be some question marks over how they're actually addressing certain environmental or biodiversity-related factors. Finally, the last thing that we need to keep in mind is, what is the actual underlying corporate governance of this entity? What is the board composition? How do they go about and structure their boards? Do they have something that we refer to as a chief value officer, where we're moving away from just having your CEO and CFO, and we actually want someone who's in charge of this value creation of sustainable development? Do they have separate environmental and risk committees that are taking a look at all of these different factors that we are seeing and these prevalent factors that are impacting our society today? So those are some of the key tactics that we as ordinary stakeholders can come along, look at and say, well, we're looking at these extra financial reports, at these sustainability reports. Let's go ahead and see, is there any red flags that we're facing, and can we try and evaluate to a sense, is this company truly trying to be an integrated thinker? And are these integrated reports a genuine application of this underlying logic, or could there be these little hints of impression management taking place? Thank you.